Disability insurance is typically sold with a handful of riders, each of which comes with an additional cost and commission for the agent. Let's go over each of those and talk about which ones I think are worth buying and which ones are not and when. The first is a residual disability benefit or a partial disability benefit rider. That rider should pretty much be purchased by everyone. It covers not only a partial disability, but also gives you a partial benefit as you recover from your disability. The inflation protection rider indexes your benefit to inflation, usually starting 1 year after you become disabled. This is a pretty important rider if you're disabled at a young age. So I recommend it for anyone buying a policy in their 20s, 30s, maybe even 40s. But if you're already 55 and the policy is only going to pay until you're 65, you can probably skip this rider. The future purchase option is an interesting rider as well. It allows you to buy a larger benefit at a later date without any pesky questions about your health or dangerous hobbies. If you're in a position where you can't afford as much as insurance as you're going to need, purchase this rider. This includes most residents, most fellows, maybe even new attendings that are in the military, anybody that's not yet at their peak earnings and can't qualify or can't afford to buy as much insurance as they'll need at the point of their career when they need the maximum amount of disability insurance. Catastrophic disability riders are basically pay out an even larger benefit if you're really disabled, defined as not being able to do 2 or more activities of daily living. Unless you're already up against the maximum amount of disability insurance you can purchase, I think you're probably better off just buying a larger primary benefit with the dollars that would go toward this rider. Finally, the retirement benefit rider is one of my least favorite. This rider, in the event of disability, causes the insurance company to put some money into some type of retirement vehicle for you in addition to paying your monthly benefit. Unfortunately, that vehicle is usually a high-expense insurance-based investing product like an annuity, and not the best way to save for retirement. You're usually better off purchasing a larger primary benefit with the money that would have gone toward this rider. Just don't forget that you need to continue to save for retirement using your disability benefit money, since the policy is only going to pay to age 65 or 67, after which you're going to be living only on your Social Security benefits if you haven't saved up a nest egg.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.